Welcome friends to the World Story Channel. I am your narrator Ramis. Enjoy listening to the full history of money. Do not forget to write your opinion in the comments, and we will proceed. The world before money, the tyranny of barter. Imagine a small, ancient village. One family grows grain, another makes pottery, and a third herds cattle. The only way to trade is through barter, the direct exchange of one good or service for another. This system was fraught with what economists call the double coincidence of wants problem. For a trade to occur, you not only had to find someone who had what you wanted, but that someone also had to want exactly what you had, at the same time, and in the right quantity. This was incredibly inefficient. How do you make change for a live cow? How do you save the value of your labor if your goods, like fruit or meat, are perishable? Barter created a stagnant, localized economy. Alongside barter, many societies operated on a gift economy. Giving a gift created a social debt, an obligation for reciprocity in the future. This was an early form of credit, built entirely on social trust and community bonds. Act 1. The dawn of the idea: commodity money. To solve the inefficiencies of barter, societies gradually converged on using certain commodities as a common medium of exchange. These were items that had intrinsic value themselves, but were also widely desired, making them acceptable to most people. Cattle, one of the oldest forms. The English words capital and chattel derive from the Latin caput, meaning head, of cattle. The word pecuniary, related to money, comes from pecus, the Latin word for livestock. Cowrie shells, used for over 4,000 years across Africa, Asia, and parts of Europe. Their appeal lay in their durability, portability, and the difficulty of counterfeiting them far from the sea. Salt, so vital for food preservation that Roman soldiers were sometimes paid with it. This allowance was called a salarium, the root of the English word salary. Other commodities, grain, beads, tea, cloth, and tools, all served as money in different cultures. This was commodity money. Its value was still based on its inherent usefulness. However, it lacked standardization. One cow is not identical to another, and was often not easily divisible or portable for large transactions. The metallic revolution, coining trust and authority. Metals like gold, silver, copper, and bronze emerged as the ideal solution. They possess the perfect combination of properties for money. Durability, they do not rust, rot, or perish. Portability, high value could be concentrated in a small, heavy object. Divisibility, they could be melted and divided into smaller units, e.g., from a bar to coins, without losing their value. Uniformity. 1 ounce of gold of a certain purity is identical to another. Recognizability. Their distinct look, weight, and sound made them hard to fake. Initially, metals were used as unstamped bullion or rings, requiring weighing and assaying with every transaction. The revolution occurred in the 7th century BC in Lydia, modern-day Turkey. The Lydians began producing the world's first standardized coins from electrum, a natural gold-silver alloy. They stamped them with a lion's head, the symbol of the Lydian king. This stamp was a quantum leap. It was a guarantee of weight and purity, delegating trust from the individual merchant to the authority of the state. The idea spread like wildfire to Greece, Persia, and beyond. Coins standardized trade, simplified tax collection, and made it easier to pay and fund armies. Value was now literalized, a piece of metal bearing the mark of a king. The paper promise, the abstraction of value. As trade expanded over long distances, carrying heavy sacks of gold became impractical and dangerous. The next great leap was the realization that you didn't need to carry the substance of value, but only a claim check for it. Tang Dynasty China, 7th century AD. Merchants began leaving their heavy copper coins with a trusted agent, receiving a paper receipt in return. These receipts began to circulate as a form of payment. By the 11th century, Song Dynasty, the Chinese government, facing a copper shortage, issued the world's first state-backed paper currency. Medieval Europe and goldsmith bankers. In 17th century Europe, people started storing their gold with goldsmiths for safekeeping. The goldsmiths issued paper receipts that promised to pay the bearer the stored gold on demand. These receipts became the first modern banknotes. Soon, goldsmiths noticed that people rarely redeemed all their gold at once. They began issuing more receipts than they had gold, lending the excess out at interest. This was the birth of fractional reserve banking and the concept of money creation through debt. The value of a paper banknote was now representative. It was not valuable in itself. It was valuable because it could be exchanged for something that was gold. Trust had shifted from the metal to the institution that promised the exchange. The gold standard, anchoring the world. The proliferation of banknotes led to chaos. Without discipline, banks and governments would print too much, leading to inflation and collapses. The solution was the gold standard. The principle: a country pegged its currency's value to a specific weight of gold. For example, for much of the 19th and early 20th centuries, you could take $20 to the US Treasury and receive 1 ounce of gold. International system. This created fixed exchange rates between currencies, as their values were all defined in terms of gold. It imposed discipline on governments, preventing them from printing money recklessly and fostering a long period of stable international trade. The Bretton Woods system, 1944, was the gold standard's final, sophisticated iteration. The US dollar became the world's primary reserve currency, backed by gold at $35 per ounce. All other major currencies were pegged to the dollar. The world trusted the dollar because America held the vast majority of the world's gold. The era of fiat, the great unlocking. The Bretton Woods system strained under the weight of the post-war global economy. The US did not have enough gold to cover all the dollars in circulation worldwide. On August 15, 1971, President Richard Nixon announced the temporary suspension of the dollar's convertibility into gold. This Nixon shock was permanent. It severed the final link between the world's major currencies and a physical commodity. We entered the age of fiat money, from the Latin fiat, meaning "let it be done." Its value is not derived from gold or silver, but from government decree. It is declared legal tender. Societal trust, the collective belief that others will accept it in the future. The management of the central bank. Institutions like the Federal Reserve now have immense power to manage the economy by controlling the money supply, printing more to stimulate growth, risking inflation, or reducing it to fight inflation, risking recession. Money had completed its transformation from an asset, a valuable thing in itself, to a liability, a form of debt of the central bank, and a social agreement of immense complexity. Act 6. The Digital Age. The Illusion of Immateriality. With computers, money became truly virtual. Your bank balance is simply a number in a database. Credit cards, wire transfers, and online payment systems like PayPal are just sophisticated layers on top of the existing, centralized fiat system. This digital layer, while convenient, reinforced all the problems of the traditional system. Total centralization. Banks and payment processors are powerful, rent-seeking intermediaries. They can freeze accounts, reverse transactions, charge high fees, and are subject to government control and censorship. Financial exclusion. Billions of people without access to the traditional banking system remain on the sidelines of the global economy. Security risks. Centralized databases are honeypots for hackers and prone to systemic failure. Bitcoin, the rebellion of code. The 2008 global financial crisis was a catastrophic failure of trust in these centralized institutions. It was in this climate that, on October 31st, 2008, a person or group under the pseudonym Satoshi Nakamoto published a white paper titled "Bitcoin: a peer-to-peer electronic cash system. On January 3, 2009, Nakamoto mined the first block of the Bitcoin blockchain, the Genesis block. Embedded within it was a newspaper headline. The Times, 03, Jan. 2009 Chancellor, on brink of second bailout for banks. This was a mission statement and a critique of the existing system. Bitcoin introduced a radical new paradigm built on several breakthroughs. Blockchain, a public, distributed, and immutable ledger. Instead of being held by one bank, it is maintained by a network of thousands of computers, nodes, worldwide. Every transaction is recorded in a block, which is cryptographically linked to the previous one, forming a chain. To alter it, you would need to overpower the entire network, a practical impossibility. Decentralization. There is no central authority. The network is governed by consensus and cryptographic proof. No single entity can control, censor, or shut it down. Mining and proof of work. New transactions are verified and added to the blockchain through mining. Miners use powerful computers to solve complex mathematical puzzles. The first to solve the puzzle gets to add the new block and is rewarded with newly minted Bitcoin. This process secures the network and makes it incredibly tamper-resistant. Programmable scarcity. The Bitcoin protocol has a hard-coded maximum supply of 21 million coins. This makes it a deflationary asset, immune to the arbitrary inflation that plagues fiat currencies. It is digital gold with a guaranteed, verifiable scarcity. The new frontier. The evolution of money is the story of the migration of trust. From trust in a substance, the intrinsic value of gold, to trust in an institution, the promise of a king, a bank, or a government. And now, to trust in a protocol, the immutable, transparent, and decentralized code of Bitcoin. Bitcoin is more than a currency. It is a fundamental reinvention of a social technology. It questions whether money, one of humanity's oldest and most vital inventions, can be removed from human hands and political whims, and governed instead by mathematical truth. The journey of money is far from over, and its next chapter is being written in lines of code and the unbreakable links of the blockchain.